Hello again, and welcome to the second installment of the Borrowing Money Workshop, Know Your Income. I'm very excited that you have decided to continue to join me on this educational experience. I'm your host and content creator, Joe Miller. Let's recap what was covered in the Preparing to Borrow Money first video. The foundation to successfully borrow money is comprised of four key components: know your income, know your credit, know your budget, and know your purpose. Each one of these components is important, and a good understanding of all four is essential to success. Just like four sturdy legs are essential to comfortably sit and relax in a chair, the four keys to successfully borrow money are essential to comfortably enjoy and afford your new car or home. By building a solid credit foundation, you will be able to control your loan narrative and obtain the loan that is best for you. Because at the end of the day, you need the loan that is best for you, not your lender or your bank or your car dealership. A loan that fits within your budget, can be easily repaid with your income, and has the best terms and interest rate based on your credit. If you don't have a solid credit foundation and understanding of your income, your credit, your budget, and your purpose, then you are susceptible to getting talked into the wrong loan terms or buy something that you'll soon regret or realize that you can't afford, even though the sales officer or lender said that you could. Or you could have paid more in fees, paid a higher interest rate, or had to put more money down than you wanted to. Bottom line is you are getting a loan on someone else's terms and not your own, thus potentially costing you thousands of extra dollars in additional finance costs. Being prepared to do anything in life will lead to greater personal success, reward, and accomplishment. This is why the Borrowing Money Workshop and Workbook are important to you. So remember to hit that like button and subscribe button below to get all the videos and information offered in the workshop. Now let's get into the training. The first key to successfully borrow money is to know your income. Understanding the difference between how much you earn, your gross pay, compared to how much you actually make, or your net pay, your net income. When a lender or loan officer is viewing your income, they are basing their income calculation on your gross salary or hourly pay over the last year or two. Then they fit you in this box, so to speak, which everyone else who earns about the same amount of pay as you do, regardless of the type or source of that income. If you earn this amount of income, then you are approved up to this loan amount. But this is very general and not specific to your own situation. This can lead to repayment problems down the road if you follow their advice only. Let's look at an example. Say that you and one of your co-workers are both paid $30 an hour. Looking at the income worksheet, that equates to gross wages or gross income of $5,200 per month or $62,400 per year. You may earn relatively the same amount of pay as your co-worker, but each person has a slightly different withholdings and costs that are taken out or deducted from the gross pay amount. Deductions can include things such as federal income tax withholdings, FICA or Social Security withholdings, health insurance premium costs, life insurance premium costs, 401k retirement contribution, dependent care reimbursements, or flexible spending accounts, and so forth. In this example, you both have the same withholdings of $900 of federal income taxes or FICA. Your health insurance premium cost is $450 per month compared to $240 per month for your coworker. The difference being is you have a family medical plan and your coworker does not. You're both investing 7% of your pay towards your 401k. Along with the family medical plan, you also have deducted $500 per month for pre-tax for child care. Based on the gross pay or gross income, the car dealership, bank, loan officer, or mortgage company says you and your coworker can afford the same loan amount and the same monthly payment. But in reality, you will have about $700 less per month in your net pay to repay your new loan. This is where I see people get into trouble. Just because you were told that you can afford that new car or the house doesn't mean you can. The key is to make sure that you can easily repay your new loan with your net pay and your budget. Now that you understand the regular income or base pay from your job and how lenders view gross income compared to your net income, let's look at any additional income you may receive, such as overtime pay, commission income, or bonus pay. If this other income is regularly and consistently received and you want to use it towards your monthly household income, then the Borrowing Money Workbook will help you calculate that into a monthly average. In order to do so, you will need to have available your most recent pay stub, earning statement, or wage statement, and the year-end or last earning statement or wage statement from each of the last 2 years. As a reminder, these are not your W-2 statements. The W-2 statements only have your gross wages and total deductions. They don't break out or itemize the pay like your earning statements or wage statements do. The income worksheets will help you figure out how much of the other income you are consistently receiving. If the other income is not being received consistently for at least the last 24 months, then income should not be used. There are formulas built into the worksheet that will conservatively calculate the other income. Basically, if you are less than 4 months into your current year, then you will need to have received the other income for at least the last 2 years. If you are 4 months or greater into the current year, then you'll need to have received the other income for at least the prior 18 months. If you are no longer receiving any other income, or you don't feel that it will be continued over the next 3 years, then I would advise against including it in your budget and instead put the other extra pay received directly into your savings account. To summarize, if you've received the other income regularly for more than 2 years, then the lender or bank or mortgage company will typically include that amount into your gross pay. And it'll tell you that you can now afford an even bigger house or even more expensive car. But any overtime, commission income, or bonus pay can easily be stopped or ended by your employer. That could put you in financial trouble down the road. This is where the budget section of the Borrowing Money Workbook will help you decide how much of the other income, if any, you are comfortable using. Each budget section gives you 5 scenarios that you can see how the changes affect your outcome. You can adjust your income, adjust your bills, adjust the loan size, and see how it will affect your monthly cash flow. More on that to come in the Know Your Budget video. So far, we have reviewed your base salary income and any other income you may receive. Now let's look at how you can create both a consistent monthly net income or net pay that you'll be used to easily repay your new loan and simultaneously create a savings account with little to no effort. Because having a savings account to pay for unexpected bills, repairs, regular maintenance, or savings for a big purchase such as a new gaming system or engagement ring, or saving for a vacation is key to financial success. Using the same example from earlier, you are being paid $30 per hour and you typically work 40 hours per week. That equates to $1,200 of gross pay per week, simply $30 per hour times 40 hours. In the earlier example, we also determined that the cost of your withholding, benefits, and retirement contributions are $1,714 monthly, excluding pre-tax child care reimbursement. That equates to $396 per week being taken out of your paycheck, as the chart on the screen indicates. So your net weekly pay, or how much you have available to spend and pay bills, is $804 per week, simply $1,200 minus $396 withholdings. That equates to a net amount of about $41,832 annually based on 52 weeks in a year. Here's a question that you'll need your calculator on your phone for. How many weeks are in a month? Well, there are 52 weeks in a year. So dividing 52 weeks into 12 months equals 4.33 weeks average per each month. Here is how you can automatically create that savings account. Going back to the workbook, let's change how you are paid from weekly to 4 times a month. That will create an extra pay every 3 months that isn't being used in your monthly budget. Using your calculator again, take the monthly $286 difference between getting paid weekly and 4 times a month that you see and times that by 3 months. That equals one monthly net pay of around $804 that you can now put into your new savings account that you will open up at your bank or credit union after you complete this course, if you don't already have one. So how does that work? Looking at a calendar, there are basically 13 weeks in every 3-month period. Or think of it as the 4 seasons: winter, spring, summer, and fall. So if you're basing your monthly budget on 12 weeks instead of 13 weeks, then you have an extra week of pay left over. So every change of the season, you are putting $804 into your savings account. After a year, you'll have almost $3,500 in savings by making this simple adjustment. The same concept can be used if you're paid every 2 weeks, as I am. This time, let's look at the salary income section. Using the same pay of $1,200 per week, that equates to $2,400 of gross pay every 2 weeks. So I'll enter that amount in the worksheet. The withholdings from your pay is doubled from $396 to $792. And lastly, the net income is also doubled from $804 to $1,608. Getting paid every 2 weeks means that you are receiving 26 paychecks each year, 52 weeks in a year divided by 2 weeks. So instead of getting paid every 2 weeks or 26 times a year, change the thought to getting paid twice a month or 24 times a year. 12 months times 2 pay periods equals 24. So you will now have, in this example, 2 extra pay periods during the year. So twice a year, you will be able to put $1,610 into your savings account. Using that calculator again, that $268 difference times 6-month interval equates to $1,608. I have found that these 2 extra pay periods typically occur in the early summer and late fall. Perfect time for paying for that vacation in summer and property taxes and gift buying in the winter. So in conclusion, what I recommend doing is to base your income on only the regular pay or base pay that you receive and put any other pay into your savings account. Or if you receive overtime or commission pay regularly with each paycheck or monthly, then maybe consider including only 50% of that income with your base pay in your budget and add the other 50% into your savings account. Or take advantage of the 4 times per month pay method or the 2 times per month pay method we discussed. A couple of things about the income worksheets. The miscellaneous deductions or reimbursement accounts can be added back towards the net income. The reason why I add back the pre-tax dependent care reimbursement in the income worksheet is because most of the times a person is paying more in dependent care costs over the year than what they can deduct pre-tax. Also, there's an expense line item in the Know Your Budget section for the actual full amount of the child care or dependent care cost for the year or month. The HSA or FSA medical reimbursement and any commuter reimbursement accounts can also be added back, as you will list those projected costs for the year in the budget workbook as well. There's also a section for people who are self-employed or have rental property or farm income, and they file as a Schedule C business on their 1040 tax return. This is typical for 1099 employees, such as 100% commission employees or consultants. Thank you for listening to the Know Your Income video of the Borrowing Money Workshop. The next video will cover Know Your Credit. Remember to like and subscribe to the channel so that you can complete the workshop and not miss any of the important information that is provided. If you still haven't purchased the Borrowing Money Workbook that was developed for this workshop, then you can do that now through Venmo or PayPal at the link or QR code listed below. If you're using Venmo for payment, then search for Borrowing Money Workbook. Remember to add your email address in the "What is this for?" text box. It is critical that you add your email address so I know where to email the workbook. If you're using PayPal, then please check that the email address on file with PayPal is your current email address. As a reminder, the workbook is a Microsoft Excel document, so you'll need to have access to a computer that has that software. If you have any questions, the email address is borrowingmoney@yahoo.com. Remember to subscribe so you don't miss any of the Borrowing Money Workshop videos. The next one to watch is Know Your Credit. Until next time, thank you again for watching and have a great day.